Self-destruct sequence activated. 3, 2, 1.
Is this your homework, Larry?
Just ask him about the car, man.
Is this yours, Larry? Is this your homework, Larry?
Is that your car out front?
Is this your homework, Larry?
We know it's his fucking homework. Where's the fucking money, you little brat?
The risk-reward ratio calculates how much risk a trader is willing to take for potentially how much reward. Now, in other words, it shows what are the potential rewards for each $1 you risk on an investment. The calculation itself is really simple. Now, you divide your maximum risk by your net target profit. Now, how do you do that? First, you look at where you want to enter the trade. Then you decide where you would take profits if the trade is successful and where you would put your stop loss if it is a losing trade. Now, this is crucial if you want to manage your risk properly. Good traders always set their profit targets and stop losses before entering into a trade. Now, you've got both your entry and exit targets, which means you can calculate your risk to reward ratio. You do that by dividing your potential risk by the potential reward. The lower the ratio is, the more potential reward you are getting per unit of risk. So let's see how this works in practice. Let's say you want to enter into a long position on Bitcoin. You do your analysis and determine that your take profit order will be 15% from your entry price. At the same time, you also pose the following question: where is your trade idea invalidated? That's where you should set your stop loss order. In this case, you decide that your invalidation point is 5% from your entry point. It's worth noting that these generally shouldn't be based on arbitrary percentage numbers. You should determine the profit target and stop losses based on your analysis of the markets. Technical analysis indicators can be very helpful for doing this. Now, so our profit target is 15% and our potential loss is 5%. How much is the risk-reward ratio? Well, it's 5 divided by 15, or 1 to 3, or 33%. Simple enough. This means that for each unit of risk, we're potentially winning 3 times the reward. In other words, for each dollar of risk we're taking, we're liable to gain 3. So if we have a position worth $100, we risk losing 5 for a potential $15 profit. Now, we could move our stop loss closer to our entry to decrease the risk-reward ratio. However, as we've said, entry and exit positions shouldn't be calculated based on arbitrary numbers. They should be calculated based on your technical analysis. If the trade setup has a high risk-to-reward ratio, it's probably not worth it and to try and game the numbers. So it might be better to move on and look for a different setup with a better risk to reward ratio. Now, note that positions with different sizing can have the same risk to reward ratio. For example, if we have a position worth $10,000, we risk losing $500 for a potential $1,500 profit. The risk reward ratio is still 1 to 3. Now, the ratio changes only if we change the relative position of our target and stop loss. Now, it's worth noting that many traders do this calculation in reverse. Okay, so if that sounded a bit off to you, that this is going to make sense. Now, it's worth noting that a lot of traders really do the risk-reward ratio calculation in reverse, so it's actually the reward-risk ratio. Why? Well, it's just a matter of preference. Some find it easier to understand. The calculation is just the opposite, and you really just get the opposite answer, but the same result. So as such, our risk reward ratio in the example we just talked about would be 15 divided by 5 or 3. Now, as you'd expect, a high risk reward ratio, or a high reward risk ratio is better than a low reward risk ratio. So looking at this example here, you can see the reward risk ratio is 3.28, and this comes as the default setting and standard in Tradingview when you do use the long or short position tool. Traders will look to trade setups where they stand to gain much more than they stand to lose. This is what's called an asymmetric opportunity, where the potential upside is greater than the potential downside. What's also important to mention here is your win rate. Now, your win rate is the number of your winning trades divided by the number of your losing trades. For example, if you have a 60% win rate, you are making profit on 60% of your trades, and you can use this in your risk management strategy to help improve the chances for your success. Now, even so, some traders can be highly profitable with a very low win rate. And why is that? Because the risk-reward ratio on their individual trade setups accommodates for it. Now, if they only take trade setups with a risk-reward ratio of 1 to 10, they could lose 9 trades in a row and still break even in one trade. In this case, they'd only have to win 2 trades out of every 10 to be profitable. Now, this is how the risk-reward ratio can be pretty powerful in your trading strategy. So we've looked at the risk reward ratio, we've looked at risk management, we understand capital preservation is the #1 priority in a successful trader's trading plan. Let's move on to calculating position size and get a feel for how we can calculate our position size to fit within our risk reward ratio that we've determined to be acceptable in our trading plan.